How to accurately trade earnings. My name is Don Kaufman. I will be your host, instructor, and trader this evening. A risk disclosure: we're not financial advisors, nor are we a broker-dealer. No soliciting, no recording, no photography. I guess don't feed the monkeys either. It's the TheoTrade Zoo. Copyright disclaimer: this is ours. This is not yours. You can watch this on a recording. We'll give you the recording. The real reason we throw this up here, all of our contact information is also here. Support@TheoTrade.com. I always make mention of this, and I want to make mention of it right up front. If you need to get a hold of me at any point, just go to support@TheoTrade.com. We answer emails here at TheoTrade. The support address is a general inbox that everybody still, if you want to talk to me, just put, hey, want to talk to Don? They'll shoot that email directly over to me. Next, a little bit about me. Again, my name is Don Kaufman. I'm the co-founder here of TheoTrade. I started trading in the late 90s, literally right out of college. Had a family that were involved in trading and got a nice opportunity about literally 3 weeks out of school. Short time thereafter, I was invited into a startup brokerage firm called thinkorswim. That's where I remained for a very large portion of my career. I was there when we took the company public in 2007. I was there when we were acquired by TD Ameritrade in 2009. I exited the TD Ameritrade firm as, again, about a 15-year career at the same company. I exited there in 2015. When I was at the time running the education side of all of TD Ameritrade and their 7 million clients. So I've had about a 20-year trading career. I do have a lot of thinkorswim platform experience. However, we're very much here at TheoTrade broker agnostic. We are now, capable of working with a number of main brokers. We've done the CNBC tour time and again over here. This is just, again, one of the more memorable CNBC appearances that we've done because they pitted me against Mr. Wonderful himself. The other aspect I always like to bring up here at TheoTrade is we're not just one instructor deep here at TheoTrade. We have pretty much stacked the deck with talent at TheoTrade. These are the instructors: Jeff Bierman, analyst, trader, former chief technician for TD Ameritrade. So if you've ever been, for those of you that are familiar with thinkorswim, Jeff Bierman helped construct the studies for the charts for the thinkorswim platform. Actually, Jeff's was around long enough that he actually helped with profit charts as well. We have Matt Williamson, one of our newest instructors. He's market neutral premium selling option strategist. Corey Rosenblum has been around the industry for quite a long time, senior strategist here at TheoTrade, and our swing trader, Brandon Chapman. Brandon Chapman also worked with me at TD Ameritrade. In fact, Brandon wrote many of the books years ago for the investment education arm of TD Ameritrade known as Invest Tools. So Brandon actually, again, kind of ran a lot of the content that got to you anyway. Macroeconomics, technicals, fundamentals, Steve Slim Miller. Steve had a 43-year career, of which he spent over 25 years on the trading floor. Last but definitely not least, Tony Rago, Nasdaq futures and intraday strategist. So we've got now 7 full-time instructors here on the TheoTrade team. A little bit about TheoTrade. We specialize in education for stocks, options, futures. All of us are professional traders, okay? Trading educators. Everybody on our crew has a minimum of 15 years of experience. That is one thing. No matter what education firm you go to, check out and see if they have 15 years of experience and have 7 full-time instructors, all with that minimum. It's a phenomenal team that we've actually put together. A couple of us have several decades behind us. And first and foremost, we're here to help you guys mitigate the risks in the market. You're going to learn a skill set that's really going to last you a lifetime. Now, let's get into this evening's presentation. This is a question, especially for tonight's presentation: are you willing to put forth the effort? The course material that we're going to be discussing today is going to be a little bit demanding to learn, okay? This is not going to be a chart pattern to follow. It's not going to be a bouncing ball, okay? Before I go any further, I'm going to tell you right now, I spent hundreds of hours looking at data sets, okay, to construct some of the criteria, which are literally the step-by-step recipe to be able to enter and exit these trades. So this is not going to be, I was reading a thing the other day, and literally somebody was like, if you follow this chart pattern, it's when X marks the spot, you're going to make money. And I want you guys to know right now, this ain't instant coffee and instant tea, right? I'm going to teach you a very definitive skill set. It's based all on statistical data, which you're about to learn, right? We're going to discuss market making. We're going to discuss hedging activity, and you better have the will to learn. And I hope that that's all right off the bat. And if I scare some people off with that, good. Because I know a lot of people always want that. They're just like, oh, just give me, the money machine that just spits it out. And this stuff took a tremendous amount of time for me to not only present to you, but a tremendous amount of time sitting in front of screens and trading and actively trading this to derive a strategy specifically for earnings and earnings related trades. Let's get started. Getting to know expected move. This is kind of part one. Now, some of you have background, okay? You know what kind of expected move is. For others of you, this is going to be brand new. Some of you guys, this could be a little bit of a recap. But let's start with volatility equals risk. Again, we're jumping into this tonight, and we've got, a solid, amount of material to cover in a very short period of time. Volatility equals risks. Option markets can be thought of as putting a price tag on risk. Now, some of you may not be familiar at all with options, but that's okay, right? The options markets, when I say they put a price tag on risk, pricing in markets is determined via market participants. Ultimately, option pricing, it comes down to what it is, it's supply and demand. So competition also breeds efficiency in pricing. Now, that's a really kind of an odd statement. You're like, oh, what does that mean? Like competition, efficiency, right? Well, you're going to learn a little bit about an efficiency trade. So let me take this a step further. Now, implied volatility and expected price moves. So what does implied volatility, what does it really mean? What does it delineate? Implied volatility is the volatility that justifies an option's current price, yada, 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 right? Okay. How can I use implied volatility in my day-to-day trading? Oh, let me see. That's the statement that you want, okay? How can I use volatility, and specifically implied volatility? So when I talk about this, what I'm talking about with implied volatility, for those of you that are new to this, is, options markets. How can I use options in my day-to-day trading? That's the question. Well, you could use the options market. Implied volatility can be extrapolated into stock price movement. Okay, or what is termed expected move. You're going to hear this term all night. EM, expected move. EM, expected move. What it means, it's how far an underlying can move within a given period of time. And that's precisely what we're going to be getting into. And it's going to provide us an edge in our trade. Now, quick review of implied volatility. First of all, there's two types of volatility. People talk about volatility all the time, so they're blue in the face. They're like, oh, look at that market. It's volatile. They don't even know what the hell they're talking about. Okay? When a market's volatile, first of all, there's historical volatility. That's how much the stock is actually moving. The annualized standard deviation, the past stock price movement. That's how much the stock's actually moving. Then there's implied volatility. Implied volatility, it's from options markets. Okay? How it actually works out. This is a slide I've been using for years and years and years. Okay? Here, bottom line. You have a stock, and the stock is trading right smack at 100. Okay? Now that stock's trading at 100, and it has a 20% implied volatility. Now, the implied volatility is derived from the options. What it really means is that stock, that stock, whatever that stock happens to be, doesn't matter. Okay? We can call the stock. That stock is capable of moving up $20 or down $20, all right? And it's going to stay in that range approximately 68% of the time. Okay? That is what volatility delineates, period. Okay? But here's the weird part of that. Let me kind of fast forward this slide deck a little bit. And there it is. There it is, the 68% of the time. But here's the weird part of it. The weird part of it is this volatility that's quoted, it's not good for one day. It's not good for 1 week. The volatility that's always quoted is good. This doesn't help you much. It's good for 1 year, right? But if you know how far the stock can move within a year, like if the stock can move up $20 or down $20 and it's supposed to stay in that range, over the next year, could you then figure out like, hey, I could take that and I could, divide it by 12. And if I divide it by 12, it would give me how far the stock would move every what? Every month. And then I could further divide that by, 52, there's 52 weeks, and I can go on and on and on and on, right? But if you know the volatility of the options market, you can actually peg how far the stock can move each and every single day. Think about that for a second. If you can peg what the volatility is, you can then figure out how far the stock is capable of moving. Now, let me explain it, okay? This happens to be none other than just a distribution curve. Don't panic. Everybody okay at this point? Okay? Breathe, people. Breathe. There's a lot to go over here. So this can be a stock. It doesn't matter, all right, what underlying it is. Let's say it's a $200 stock. I mean, for all we care, it could be Apple, right? It could be Apple. So it's a $200 stock. Now, we're going to look at a 200 call. This is a call option. And we're going to look at a 200 put. Okay? And what you're going to find is the 200 put, let's say the 200 put is trading for $3. Okay? And the 200 call, it's trading for $3. Why? Because the stock is right smack at 200. So you have a 200 put trading for $3, 200 call trading for $3. And again, I know the pricing's not perfect, but this is just for argument's sake. All right? Well, what that amounts to, if you add up the price of the put, so we add the put, okay, to the call. What does it equal? $6. Okay? Well, $6 happens to equal, in this case, the expected move. That's one of the ways to derive expected move. So then what do you say after that? You're like, well, a $6 expected move, that means this underlying, okay, whatever this underlying is capable, let me clear the slate here for a second. This underlying is capable, it's a $200 product, of moving up $6 or down $6, okay? And let's say it's capable of doing that within 1 month of time. How often is it supposed to stay in this range? Approximately 68% of the time. Now, if you looked back, historically speaking, you're like, well, will it really stay in the $6 range? You could actually look back at tens of thousands of occurrences. And this is incredibly efficient. It's incredibly efficient. The options marketplace has done a stellar job of pricing how far a stock can move within a given period of time. Now, I just wanted to cover a little bit of background on this, okay? Because we're going to get into specifics and we're going to go through a lot of examples. And I'll show you like which options work and which options don't work, okay? And all the little nuances. But right now, we're still in what I would call the Disneyland of understanding an expected move. Like, this is a small world after all. We haven't actually showed you a live example yet. And that's what's important. So if this $100 product, I can tell you how far it can move within 30 days. I can tell you how far it can move within 60 days. I can tell you how far it can move within 90 days. It's just math, people. It's not that hard, okay? And I can give you a 68% probability. Now, expected move and probability. Expected move defines one standard deviation. Now, everybody always asks me, like, where's the 68.3% come from? It's one standard deviation, okay? And that's where people start to panic. They're like, I just want to look at a chart, man. Just leave me alone and let me look at a chart, okay? The way things work is very simple. This is a distribution curve. Forget about stocks for a second. Distribution curve. Almost everything you do in your life fits under a curve, right? And I love this example because there's like, I guess there's really, really good drivers, okay? Good drivers are all the way up here on the curve. And then there's really, really bad drivers, and they're down here on the curve. But most of us fit, when it comes to driving, into the meat of the curve. Unless, of course, you have a Tesla and it drives itself until it doesn't. But you guys get what I'm saying. Like, everybody fits into the meat of the curve. Now, everybody, by the way, everybody believes that we're all crappy drivers. You're a wonderful driver, but everybody else is a terrible driver. Okay? Well, that just basically shifts the curve. Even good is kind of bad. You get what I'm saying, though. 68% of everybody kind of fits right into the meat of the curve. And it's just one way to kind of, again, express what a standard deviation. So there's a 68% probability of an underlying closing inside the expected move by the designated expiration. Okay, it's what they call a probability of expiring. Now, let's show you for real. Okay, expected move calculation. First of all, not every trading application has expected move, but you can use what's termed an at-the-money straddle as an alternative to the expected move. Add the at-the-money call and the at-the-money put for any selected expiration cycle. Okay, there's people that are listening this evening that have never had experience with options and options trading. As I said, that's okay, because I'm going to show you precisely what this means. Okay? What I'm getting to right now, and the point that you should take away right now, is that, listen, there's options for 2 days. There's options for 9 days. There's options for 16 days. Do you realize the expected moves? They're right in front of you. Okay? Question mark. Do you use these? By the way, this is not a rhetorical question. You know, if you're watching this on a recording, answer yourself, people! And you should answer in the Q&A section right now. But do you use these expected moves on a day-to-day basis in your own trading? Whether you're trading stocks, options, futures, it doesn't matter. The marketplace is telling you, okay, what it is going to likely move. So you could use them for like risk management. See, the thing is, I want you guys to be able to take something away tonight that maybe you never used before. Some people are like, yeah, I totally use them. Like, I get it, you know, and some people are like, oh, I never really looked at that. But I want you to be able to use something like immediately. Okay. And the expected move is huge. Like if you know a product can move $1.20 or is supposed to move $1.20, and just think about that statement for a second. In the next, for example, 2 days, that's 2 days from expiration, this product's supposed to move $1.20. Do you realize that if you set your stop order inside an expected move, the probability of you getting stopped out, it's almost all but assured. The marketplace is telling you it's going to fluctuate right in your face. But what happens if you don't have these expected moves? You know, not everybody is on this piece of technology. People, that's fine. You know, I didn't always have thinkorswim. Before that, we just, you know, stood on a trading floor and looked up and we're just like, what's the expected move? This is how we used to figure out expected move. This is one on Intel. So let me show you. This is an example on Intel. And it's a really pertinent example in Intel because this thing is going to come into play because I've traded Intel quite a bit. So here's Intel. And what I'm showing you on Intel, there are 2 days remaining to expiration. And if you look right up here, that happens to be the expected move. It's $2.40. Okay. But if you just added the at-the-money call and the at-the-money put, it too equals $2.40. Now, this little dirty method here of add the call to the put ain't perfect, but it's good enough. It's kind of like playing horseshoes, you know. You ain't going to hit it every single time, but it's good enough for our calculation. And this calculation in thinkorswim, it's just a little bit more precise, and that's important. Okay? All right. So let's have some fun now. Okay? By the way, in statistics, you know, 68% of the time, immediately, okay, those of you that kind of get this, they're like, well, what happens to me the other 32% of the time? You'd be like, oh, don't worry, you'll find out. You get these wicked moves, all right? And you absolutely can. So we need to understand, to look at this expected move, to be able to derive the type of trade that I'm about to bring to your attention. Now, moving right along. So expected move, all right, EM equals expected move. Expected move has no directional bias. There's absolutely no directional bias. Say what you will, but people are like, no, it's definitely bullish. Well, expected move doesn't know anything about direction. Expected moves are based purely, okay, on a volatility model. However, recognize the implied volatility is based on live markets, whereby there are often hundreds of millions of dollars setting the volatility in the options and expected move. So here's the weird thing about expected move, okay? People look at this stuff. They look at the expected move and they're like, okay, all right, this stock is supposed to move up $3 or down $3. And they're like, oh, okay. Do you just accept that it's supposed to move up $3 and down $3? Okay. Well, where did this $3 even come from? It came from supply and demand. People, there's hundreds of millions. In many cases, there's now billions of dollars setting the expected move. This is not like some chart pattern. This is not like, oh, when the doji star crosses over this. Okay, this is not, Fibonacci and I got your 618 right over here. It's none of that. Okay, this is about money setting marketplace. Money setting marketplace. And when money sets the line, okay, when I say money sets the line, money will defend the expected move. That is one of the critical takeaways from this. It is not just what you think expected move. It's not just some like random equation, okay, that some monkey came up with. Expected move is hundreds of millions of dollars setting the line, okay, in a marketplace. Now let's get into using expected move. Expected move can be a phenomenal resource. But here's where the rubber of expected move meets the road. And that's what's important. Okay, deep breaths, because we're about to get, deep. The efficiency of the markets, okay? And when I say we're about to get deep right now, here's where kind of like sit down, strap in, tune in, turn on, because I'm going to take you through some fairly wild little examples, but this stuff is of critical importance, okay? Even if you're not like into the type of trade that I'm about to display to you, this is how markets function. And this is what people don't really understand, okay, about the depth of these markets today. So let's start with the idea of this, the efficiency of the markets. Trading firms buy and sell options. What's a trading firm? Well, a company like Citadel is a trading firm, but Bank of America is a trading firm, aren't they? Citigroup is a trading firm. What else? Okay, I can go on and on and on. All your different banks, JP Morgan. Last time I looked, they got a pretty big trading desk too. Okay, there's thousands of different trading firms. Imagine that you are a trading firm and you sold 5,000 at-the-money straddles for $4 credit. What do you want the markets to do? Anybody? Okay, you just sold 5,000 straddles for a $4 credit. Now, what do you want the markets to do? Anybody? Okay, stay within a $4 range. Now, let's extrapolate this out a little bit. So, there's our lovely distribution curve, okay? And this is a $200 stock, and we have just 1 week to go to expiration. Just 1 week to expiration. A firm goes out, they sold 5,000 straddles for a $4 credit. What do they want the stock to do? They want that stock below what? 204? Or they want that stock above what? 196. They really want it inside of that range. Why do they want it inside the range? Okay, because if it starts to move outside the range, what's going to occur? They just sold 5,000 straddles. Okay, it starts to trade outside the range. Well, they're going to take a little bit of a hit. Now think about it. That stock can move up. That stock can move down. Okay, what do you think that trading firm is going to do though when the stock moves up to 204 or down to 196? What do you think they're going to do if it actually touches up here or touches down there? Okay, I'm going to tell you exactly what they're going to do. All right, they're going to hedge. They're going to defend it like there's no tomorrow. They're going to defend this trade tooth and nail, and they're going to do it very, very actively. Defend. They can't get out. Can't get out of 5,000 straddles. Why? Everybody's going to see it. They're all going to see it. They can't get out of it. Be like, oh, yeah, you're the individual that sold 5,000 straddles. Would you like to buy them back right now? Oh, for the low price of, you are in trouble. They're never going to be able to get out of it. The hedge that holds the markets. So what does the trading firm do if the stock starts to move in or around the edge of the $4 credit they receive for the straddle? They hedge. Trading firms today use algorithms. This is where algorithms come into play to buy and sell stock in real time to hedge the risk of the collective straddle. So, if the stock moves big and the firm is short the straddle, they don't take a large loss as they're hedging with the shares. Now, this is the point that everybody seems to miss, and this is what's called the hedge that holds the markets. All right? So they want that thing to stay inside of the range. And as the market goes up or as the market goes down, they're actually using algos in real time to what they call neutralize the delta. Okay? They just keep taking the delta back to zero, back to zero, back to zero, back to zero, right? Even if the stock goes all the way up here, if the stock went to 208, they don't care. All right? They just hedge the hell out of it and hedge it. But there's an issue with hedging, okay? And I'm going to show you exactly what the issue is. And this one is going to blow your mind. So if a stock moves big, don't think for a second. Don't like, oh, I feel so bad for that trading firm. Don't feel bad for them. By the way, the algorithms, that's an auto hedge. You don't even have to do anything. It automatically does it for you. They sit back and they just watch the screen and they go, ooh, I hope we don't move more than $4. But if we do, I have a hedger. And that's exactly what they do. But people forget about something. For every buyer, there's a seller. Let's not forget for every buyer there's a seller. Because the firm that sold 5,000 straddles, they had to sell them to someone. And that someone is likely another trading firm also using algos to hedge their collective risks. Now, we have both a buyer and a seller surrounding the $4 straddle. Two firms battling to the death, using algos to control risks, and the end result is the underlying stock moving $4 to the relative advantage of no one. Now you got to think about this because this is the trade that nobody seems to recognize right now, right? You have one underlying right here. It's a $200 stock. You got one firm that's making a bet, all right, that it stays inside, okay, of a range. But you have another firm on the other side of this. Okay, so as the stock starts to move, the hedging activity draws the underlying to each side of the expected move. Now, there's no directional bias. You can't tell me in the beginning of the week, are we going to go up or are we going to go down? Those are market forces. But if we go up, we're very likely to stick right around 204. But if we go down, we're very likely to stick right around 196. Why? Because one firm's a buyer, one firm's a seller. They're actually both using algorithms. That's the efficiency of the market. That's the hedge. Time out. Does this make sense to you? Okay? It's okay. Take a deep breath. Because this is where people, like, if they tuned in for the first time, they're like, I had no idea. Question is, why aren't more people looking at this? Why aren't more people looking at this? They're not even aware of how the entire professional trading arena works. Okay? They're just not aware. It's all auto hedging. Okay, there's no MACDs, there's no Fibonacci's, there ain't no Bollinger Bands on a trade desk, right? How could I possibly know that? Well, because I helped build technology for the professional world, okay, for the better part of 15 years, right? Who do you think's put some of those algorithms together? Thinkorswim, when I worked there, wasn't just a retail trading application. We had a professional trading application. It at the time was called Liquid, but now is called Pipes. It's still used in the industry to these days. And a lot of the algorithms designed, we had huge input to these, right? But today, now, the efficiency is far better than it ever has been before. And when you think about this, we move to the edge of these, and I said, like, to the relative advantage of no one, but that's, of course, no one until us retail monkeys found edge in trading the scraps of the big gorillas. That's exactly what we're going to do over here, okay? So at this point in time, if you're a little bit confused, and it's okay, right? If you're a little bit confused in this entire hedge idea, here's what I want you to be able to discern at this point in time, okay? We have this distribution curve, okay? We have a trading firm that sold 5,000, and we have a trading firm that basically bought 5,000, okay? For every buyer, there has to be a seller. Everybody's like, oh, they sold 5,000. Yeah, well, somebody bought them, okay? Both of them collected this $4 credit. All right, one paid the $4 and one actually sold it for $4, but both of them are on the hook $4 out of the money. And if the underlying starts to move, there's a very high probability that it's drawn to one side of this expected move or the other. Ooh, by the way, we're making a nice drawing over here. Oh, give it some other eyes in there. Those are its ears. It's fun stuff. This is the trade, okay, that's going on. Here's a quick summary. Supply and demand, okay, determine the expected move. Tens of thousands of option contracts are based on the expected move in the days leading up to earnings. Now, everybody forgot that this webcast this evening is supposed to be about earnings. How does this even deal with earnings? There's a method to the madness. I had to teach you about expected move before getting up to the earnings. See, the cool thing about earnings, well, tens of thousands of option contracts are based on the expected move in the days leading up to earnings. See, earnings are the epitome of expected move. They're the epitome of expected move. Trading firm Algos buy and sell stock to mitigate their directional exposure. If the trading firms have positions in a stock, the exposure is likely neutralized at or near the edge of the expected move. Algos, through the course of hedging, drive stock to the edges of the expected moves. Now, put this in the context of an earnings announcement. Okay? Can you imagine if this is something like, all right, Apple? So this is something like Apple, and Apple's expected move is plus or minus $8, supposed to move $8, and it's this $200 stock. Okay? And there's firms that have just tens of thousands of option contracts and literally billions of dollars at risk. What's a likely outcome? Likely outcome is we're going to move up $8 or down $8. It's a highly likely outcome. You just don't know which way we're going to go. Now we're going to show how to take advantage of this, okay? Because this is the most important thing. Gravity, earnings, and expected move. Trade logic and structure. In heavy liquidity, okay, equities. So that means heavy trading equities. Expected move tend to work like gravity, sucking price to the edge of expected move shortly after the earnings announcements. Check it out for yourself. You can look at thousands and thousands of data points. You're going to see stock moving right to the edge, stock moving right to the edge. We are seeking a statistical edge in trading the morning after a major earnings announcement. We have no intention of trading in the after hours. However, in limited occurrences, we may seek a trade in pre-market. When price is slightly outside expected move, we will trade either long or short positions looking for the equity to revert back to expected. Now, by the way, all this verbiage in this one slide, you're like, you're killing me, man. You're killing me. Well, here, I'm going to break it all down for you because this trade will make a lot of sense once you see it, okay? Would everybody agree this evening? You're here to find a definitive edge in this marketplace. Okay? And the only way to find definitive edge is not going to be, again, we're past the idea of MACDs and Fibonacci's and Bollinger Bands. And I mean, come on. We're in a marketplace with algorithms. We're in a marketplace with artificial intelligence. And we still have clients, they're looking at a chart and they're like, the red green says we should buy now. It's getting ridiculous. Okay? You have to look beyond that. You got to look to the efficiency of this marketplace to get anything done. Let me break the trade down for you and show you precisely what happens in earnings, during earnings, and after earnings. And let me show you why, okay, I trade this consistently. Okay, here we have a stock. It doesn't matter the stock. And by the way, I had to look at literally, okay, hundreds of hours of data. And that was before ever executing a trade. And now we've executed hundreds and hundreds of trades in this. Here we have a stock, okay? Now, the stock has an earnings announcement due out. And the earnings announcement is due out, okay, today. When's it due out? After the bell. It's called PM. Okay, today in the PM. You look at the expected move. You look at this expected move right after the bell goes off, meaning the market's closed. Okay, the market's closed. The market on this stock was supposed to move up $3, okay, or down $3. Now, you have no idea which way it's going to go. And here, we're still in the evening. This is it. Ding, 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 ding. The market closes. That's right where the market closed, right? So the market closed. Now, a few minutes go by, and all of a sudden, boom, the earnings come out. And you're like, it's a party. The earnings come out, and now the stock shoots through the roof, and it's up $4. Stock's now up $4. Let me ask you a question. How far is the stock supposed to move? Anybody? How far is the stock supposed to move? Well, the expected move said it was supposed to move $3 higher or lower, but now it's moved $4. However, here we are in after hours. And in after hours, most of the big trading firms, I don't really want to step in and use their algos. Why? Because they know it's a wide bid-offer spread. They know, you know, everybody knows. Well, maybe not everybody. Okay, so the morning after the earnings, okay? The market is going to open right here. Ding, 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 bell goes off. We execute into the trade. Market comes right back to exactly the edge of the expected move and will resonate there for the remainder of the trading session. The break to the downside is the edge. It's how to construct the trade that we need to be concerned with. I know that this, like, people are looking at this and like, whoa, man, there's a lot. There's not a lot. There's not a lot. You have to understand the expected move. Okay? The whole key to the trade, though, is right here. You need to know, when do I execute? How do I execute? What do I do? Do I short the stock? Can I use options on here? The bell just went off. I'm kind of nervous. The trade, how long is it going to last? I have so many questions. Okay? Statistically speaking, the reversion back to the expected move is spectacular. Okay? Meaning that the chance of the stock trading right back to the edge of the $3 move is phenomenal. And it produces a wonderful edge for us retail monkeys. We're all retail monkeys, okay? And that is the setup. Now, I'm bringing to you the setup. Do I want you to run out there and be like, okay, I'm ready to fly. I'm ready? No, okay? You got to get the nuances. You got to get like how much risk to have. When do I execute the trade? How do I execute the trade? How do I convert this to options? How do I actually find the right expected move? The nuts and bolts behind this, the criteria, are what the trade's about. Okay? Now, that's just one. This is just, again, the for example. And excuse the, the brief example in here. A little, it took me long enough just to put this one together. I traded this thing so many times that this is just kind of the prototypical setup. Now, you want to see a real one? Here's a real one. Fade to the expected move. Okay, this is a real one. And you're like, what do you mean it's a real one? Okay, this is a stock. It's a stock. And I just found one that's recent. Listen, earnings is coming up. There's not a whole lot of earnings right now to deal with. So I didn't have a lot of a ton of examples to go from. But here's Cisco. Cisco, okay, had an expected move of $1.93. Closing price of Cisco was right here. It was right around like 43.86. The earnings came out. Boom! That stock goes up what? $3 full. But the expected move was $1.93. There's the regression. Okay? Now this started in the pre-market. You didn't have to enter into the pre-market. You could have even entered here. It came back down even more. There was plenty of edge. This trade, we were plus $1 on, okay, by the exit. This is actually a really clean version of it. And it may not look so, like people look at this the first time, like that's the way this thing trades. Okay. It's the regression back to the expected. Why? Because this is when algos attack, and the algorithms attacked, right, and faded us directly back to expected at the cash open. Got it, everybody? Now, the questions that are coming in, okay, people are like, are you only holding intraday? Are you doing this? I got to show you something about this, okay? First of all, it is an intraday trade. You are never in danger because you're not going to hold through the earnings. You're after earnings, okay? After. Okay? I'm going to show you another setup over here. And I can't stress enough, like, this is not, like, people are always looking for that holy grail. There's no holy grail, okay? It's just a heck of a lot of work and a lot of research on this front. The chances of the regression, okay, are beyond 70% in the data set that we ran. That was a question that came in. The chance of the regression back to the edge of the expected move is in excess of 70%. Now, I'm not going to go any further than that because I can't give everything away inside of this particular example. You're already seeing quite a bit. Now, I'm going to lead you to this. Here's a Nike EM earnings trade. That's what I call it. I call it an EM earnings trade. Why am I picking on Nike right now? Well, let's look very, very carefully at this. First of all, this is Nike. That was the last price it traded. When? That's today. It's right now. Right now. Listen, what's the expected move? The expected move is $4.40. How much did it really move? Less than that. So here's one. And by the way, why am I using this example? Because it's today. It's right here. It's right in front of you. Okay? It just doesn't get much cleaner than this. Imagine that this was an $85. I'm just going to round it, right? So it's an $85 product. The earnings came out. By the way, the irony with the irony with Nike is the earnings were good and they took the stock down. What did they take the stock down to? Let's just call this, they dropped the stock to $82. Now, okay, is it a good setup? So the stock is down $3 in the after hours, but the expected move, $4.40. Okay? This one, we will not know, okay? We will not know definitively if it's a good setup until tomorrow morning. And tomorrow morning, we're going to look for something very, very specific in here. This is actually the trade after hours. And I wanted to show this to you because I want to show you the efficiency trade. Here, it's an $85 product. It's at $85 right there. What did it trade down to? Right there, it's low. What's its low? $80.75. Do some quick math. What is that? Okay, down to $80.75. Oh, it's $4.25. What was the expected move? Well, the expected move, oh, I'm sorry, I was so far off. It was $4.40. Talk about close. Okay, that's in the after hours. Now, in the morning, we will look, okay, to possibly hop on this for the edge to come right back into the expected move. It just, again, I cannot tell you yet definitively if this one works. Okay, this, it's all about the morning of. And we have developed very specific criteria, okay, for this trade. By the way, somebody was saying, won't implied volatility drop off after the earnings? Of course. That actually makes it, like, that's what makes this trade so good, especially if you want to trade this with options. You know, the options the morning after the earnings are dirt cheap because all the risk is out, okay? And they're trying to peg the edge of the expected move, and that's what this is important. Now, this is what you're going to need to know to really successfully trade with an edge around earnings. And again, that's what we're doing here. Like, we're just looking for one thing, edge. It's just about edge. It's about a statistical advantage in here. Number one, what makes a viable earnings trade candidate? Like, what would we want to look for in this? Okay, not every earnings is going to make a viable candidate. You have to have a certain set, okay, and a data set in front of you. If we could lead you right to the right candidate, it's going to help substantially, right? I know the expected move is important, but what do I do once I find the expected move? Okay, so we got to find the right candidate, and then we got to find the expected move. And once you have the expected move, you're like, oh, what do I do with it? How do I set up the trade? And what entry points do I use? Okay, do I get long or do I get short? You could do either. By the way, some people are like, I can't get short. I'm in an IRA. Guess what, people? I trade every day now inside of my IRA. I have hit the age where I can trade in my IRA. It's okay with me. Okay? Can I do this with options? Yes, you can. In fact, to be able to get short in an IRA, you're going to have to use options. How do I know when to get in and get out? It's pretty critical, right? How do I size my trade? How do I know what the right amount of risk is for me? And that's what we do here at TheoTrade. It's all about the criteria of this trade. If the data and the expected move make sense, okay, the criteria is easy. All we do here is just build, okay, a recipe for trading. Okay, it's all about just answering the what ifs. We'll give you an answer to what might be a good earnings candidate, the correct options expiration, how much capital to commit, when should you execute the trade, what strike options do you buy, what do you sell? We have the answers to all of it. We just build a recipe, definitive checklist for each entry, exit, unique variable you're going to encounter, the how, the when, the why, okay, at what price. But that's just the beginning of the variables you're going to face. when you're trading around earnings and expected moves. Like earnings, it's a fast-moving situation. Want to make sure that you get this stuff right. The secret, it's in the sauce, okay? You can read about expected move pretty much anywhere. You can Google expected move, and I'll tell you what, you Google expected move and you go look at YouTube videos, it's probably going to have, TheoTrade and my name pop up in there. But that's not going to help you build a trade, okay? Because we spent years fine-tuning things like expected move. By the way, that expected move equation on thinkorswim, that was, it's my baby. I spent years working on that stuff. This is just applying the expected move into, of course, earnings and earnings-related trades, okay? Again, we spent years fine-tuning all the criteria for this, okay? And here's how you can trade earnings, okay, with a very definitive formula. This is the trading earnings formula. We have a workshop, the curriculum for a class that's upcoming. Now, a little bit unique for us at TheoTrade. We're going to do the class live, and we're going to do it live this Saturday. A lot of the classes we do, we archive them. We record them, we archive them, we just let you go after them like immediately. This class, this one's going to be live, and there's going to be thousands of people attending the class, obviously because the earnings season is coming up. Some of the curriculum include how to find edge and exploit it when trading earnings announcements, put the odds in your favor, how and why expected moves around earnings can create opportunity. You saw that tonight, okay? How to find exceptional intraday setups when trading earnings, okay? It's the highest probability you're going to get around an earnings trade. How the market provides predictable, or what we term manipulated ranges in expected moves. How expected move and option pricing can actually assist you in really entering a lot of different trades, but this one specifically is around earnings. The precise criteria, step-by-step guide to walk you through. This is all included in the class, okay? Then we get into how to minimize risk and maximize returns, how to generate, okay, trades on an intraday basis. And yes, these are intraday trades. Doesn't matter whether you have a small account, a retirement account, what stocks are going to make the best candidate, what strikes and expiration to select, when to open, when to close these intraday trades, how to create the right risk reward. It's actually one of the most crucial portions of this trade. Okay, what times are setups for entering and exiting the positions? And again, it's all about putting probabilities on your side. The class, as I said, takes place this Saturday. It's September 29th. It's 3 hours. It's 10 a.m. to 1 p.m. The class is archived immediately and will provide you 24/7 access to it. Okay? Again, some people are like, oh, I already have plans for this Saturday. It's okay. The class is archived. However, if you can make it live, I strongly urge you to do so. It's just a great time to be able to ask a couple of questions during the live course. Of course, we answer questions live when we're on there. We'll even have a number of follow-up sessions, okay, of course, that you can check out and ask questions there. But again, it is this Saturday. It is a 3-hour course. We'll probably eat every bit of the 3 hours and then some. The class is $199 if you would like to attend this Saturday. We do, okay, have a little bit, okay, of an offer involved in this. Now, most clients coming to a webinar like this kind of feel like they've been there and done that. And many of you, you kind of tune in. You've been through the gauntlet of a lot of paid classes, a lot of indicators, a lot of what I call secret squirrel black boxes. It's the X factor. It's the red and green flashing arrows. And you just keep finding like it's only to buy this one more last thing. It'll make all the difference. But wait, there's more. We at TheoTrade have had enough of what I call the educational garbage, the educational sales pitches. And we're trying to put an end to all of that. Okay? We're trying to disrupt financial education. We're built by professional traders, okay, with a minimum of 15 years of experience, not professional salespeople. We want people, okay, to be a part of TheoTrade that really want to learn this business. Educating you is our only goal, and we like to demonstrate just that. educating you, I'm going to strongly say this again, it's our only goal. And hopefully we change the way that you view the entire financial education. Okay? We now offer what we term Total Theo. It's unlimited streaming monthly membership. Think of this as the Netflix. It's like a Netflix for the financial world. What's Netflix? It's everything you ever wanted to watch and more, right? And we're providing that now in the financial world. Total Theo Unlimited, it's $99 a month, okay? The workshop that we just discussed, it's included in Total Theo. But you also, and additionally, have access to stream over 74 other trading classes, all available immediately. Those are all on demand. You can, again, start going for it tonight. Start viewing it. It streams just like Netflix. There's new monthly classes. This trading earnings formula workshop is the new monthly class. By the way, we also have a live trading chat room. You want to go in the live trading chat room? It's 6 hours per day. We broadcast 6 hours a day. I know some people can't make that, right? You can't make it? It's okay. It's archived. We have 59 proprietary indicators and scans. You could, download those anytime. We email you out trade ideas. We have daily coaching sessions. Okay? All of it's archived, and our instructors will actually answer your questions via email. It's TheoTrade.com/EF. Now, I'm going to show you a few more things about this, okay, before we go on and answer a couple of questions. And if you want to see what our members are saying, okay, again, it's, I love this comment, so I have to read it. From TheoTrade chat room. It's so amazing what we learn when we listen. Thanks to my ex-wife for this quote. Don's a wonderful teacher. Oh, man, I love that. It really is one of my favorite quotes in there. Okay. And I like to read this other one. It's really refreshing to have guys putting this together and sharing knowledge and not upselling everything and turning and burning your customer base. You got a customer for life. It's as if we're giving you $100. Now, the reason I say it's like as if we're giving you, if you want to go and you want to buy just this class, absolutely we'll sell it to you. It's $199. It's just a one-time fee. It'll give you the trading earnings formula workshop, and you'll have access to it live, and you'll have access to it for an archived year. Okay? Total Theo Unlimited Streaming, well, that's just $99 a month. It is a membership. Can you cancel at any time? Yes. You're not signing up for a year. It's $99 a month, period. Okay? You don't like us? Listen, we'll part ways happily. But you know what? We're so sure that you guys are going to like us. Okay? At $99 a month, you're probably going to love us, that we're willing to discount the class by $100. That's why it's as if we're giving you $100. Take the money. You get 74 classes, new monthly classes. There's nothing outside of what we're doing that you're going to need to trade in this business. And that's what we're trying to accomplish here. Now, again, I want to bring up the web address for you, and then I'll show you a little around, okay, our entire platform here at TheoTrade. If apparently I could pull this up, okay, which it doesn't want to currently do. All right, I'm bringing up another browser here momentarily, so bear with me. Hey, there it comes. All right, we're good to go. So we'll got it up there, and there we go. First of all, the course itself, I'm going to maximize this for you. Okay, it's TheoTrade.com/EF. What does EF stand for? Earnings formula. It's just TheoTrade.com/EF. Okay. This is Total Theo Unlimited Monthly Streaming. You just add to cart. It's $99. There is no minimum, like monthly. Like, again, cancel anytime. It's the number one question that comes up. If you would like to just take the class, you can pay $199. Okay? Some people are adamant about that, and that's why we do it. Feel free to look through what we offer here, okay, at TheoTrade. Now, when I say feel free to look through what we offer, all the different stocks, classes, but I'm going to show you briefly around. This is the TheoTrade chat room. This is the chat room. Obviously, we're off air this evening. The chat room itself is down below. We stream live in this chat room 6 hours a day, but maybe you're brand new to this and you don't know where to start. Well, guess what? We have something called Start Here. And here it is. Start Here. This is Options 101, Options 201, Options 301. Then we get into order execution, preparing for your trading day, okay, crash course in Greeks, right? There are lots of sessions to get you ramped up into this. Then we come to our class archive. This is all of the classes. Now, the classes themselves, okay, I know that there's lots of places you can go for classes. They'll probably charge you anywhere from $500 to $1,000, okay? There is no other archive database anywhere in this industry for any amount of money, okay? Recognize that many of us, years ago, I ran a part of an education group. While I was at TD Ameritrade, I ran part of an education group. They charged $24,000 for an 18-month education. And I'm going to tell you right now, what we have in here is far beyond that. It's far beyond what they did for $24,000 for 18 months. Just in option strategy classes alone, okay? You can stream as many of these as you want. You want to binge watch? Go for it. Selling premium and managing risk. Collecting guide, the guide to collecting, income, being short, covered calls, option Greeks, learning ratio butterflies, the fruit fly. The fruit fly is a newer trade. Duration iron condors. You name a strategy, it's in here. And we're not just about options. Okay, we have intraday classes, we have trend trading classes, we have technical analysis classes. Okay, if you are into charts and Fibonacci's, okay, hands down, we got your Fibonacci expert, Slim Miller. The guy's unbelievable. We have mindset and trading plans. There's a class that we initially sold in here, like 2 years ago. We initially sold the class. It's $1,000. Okay, now we just stream it and stream everything at $99 a month. Here's all the shared charts. Okay, for $99 you can enroll. You can download as many of these as you want. All right, there's 59, I believe, in here right now. Okay. It goes on and on and on what we offer. By the way, the entire archive it's all searchable. So you can search through there like you're searching through Google. Now, let me throw up the address one more time. It's TheoTrade.com/EF. I'm going to answer a few questions. First one that always comes up, is this a membership for $99 and can you cancel any time? Yes, absolutely. Number two that I want to address, we have a negotiated commissions rate. Currently, the best negotiated rate we have is with TD Ameritrade. The TD Ameritrade rate, I cannot mention it live. If you have a TD Ameritrade account, okay, and you enroll for either the class or unlimited streaming, okay, we will then tell TD Ameritrade and we will adjust your rate. We will walk you through how to adjust your rate with TD Ameritrade. However, we have a number of discounted brokerage firms. So yes, you will qualify for a discounted brokerage firm rate having signed up for a monthly streaming membership. Listen, at $99 a month, as I said, there's just nothing in this industry comparable to that. The next thing that always comes up, by the way, if you have questions about that rate, okay, feel free to chat in. If you have a TD Ameritrade account or you're thinking of opening a TD Ameritrade account, we will give you a link to that, okay? And again, the rate is predominantly for options. Their stock is already pretty good. So their stock rate is actually pretty good over there too. Anyway, to move forward, okay, to move forward with this. All right. Couple other questions that came up. If you can't get approved for options, we can help you get approved for options. Can you do this stuff in an IRA? Absolutely. Day trading margin rule. We can help you around the day trading margin rule. All right. Again, after 15 years in this industry, I can actually help you with that. I can't make the class live. Will it be recorded? Of course it's going to be recorded. Now here's one that just came up in the chat room. I can't get my head wrapped around options. Am I going to be able to follow along in the class? Absolutely. However, I do suggest going through the options 101 and options 201. It's not going to take you a huge amount of time. And again, it will help extensively going through some of the basics. Okay. Another question that came in, I don't have that much time to trade. I work full time, but can you do this? Absolutely. A lot of the strategies we talk about, but the key to this is we want you to be trading earnings and follow the trading earnings formula. That's what this class is about this Saturday. That's why you're enrolling. Everything else in there at $99 a month is just gravy. And that's why we're discounting by $100, okay? Because we're so sure that you're going to love everything that we're doing. That's why we're doing it at $99 a month, because we hope that you're a client for life. With that, I want to thank everybody for joining us. I like to be prompt. I like to be on time. We're just at the hour mark. I will sit here. I will answer some more questions in the chat room. Please enroll now, TheoTrade.com/EF. If you have any questions, you can hit us. We're here live right now. You can also hit us at support@TheoTrade.com, and our 800 number is in here as well. When I say we are here, we are right here. We are live in chat. There's the support. Okay. Again, the web address is TheoTrade.com/EF. Thank you, everyone, for joining tonight. Have a wonderful evening. Bye-bye.